everyone, I'm Kate Wilson, Head of Global Consumer Credit Deposits and Payments Research at RFI. And today I want to talk to you a little bit about what we're seeing in our recent research around mortgage stress. Really topical for us here at RFI at the moment, something that's obviously having a really significant impact around the globe. And we do mortgage research in a number of different markets, and we are definitely seeing the extent to which consumers are responding to the rate rises that we have seen through the back of 2022 and into 2023. In Australia, where we do see a mostly variable rate market, we've seen the changes from the rate rises come through pretty immediately in terms of anticipated customer stress. In Australia, 22% of borrowers in December 2022 told us that they were worried about meeting their repayments over the next 12 months. That's up from 14% prior to the first rate rises in May last year. And it's also quite a lot higher than what we saw during the last time we saw rate rises in 2009, so pointing to the fact that consumers are more stressed than they have been in the past in a similar sort of environment. Actually, the only time that we have seen stress higher than it currently is in Australia was during the initial wave of the pandemic in March 2020. If we look at other markets, we're seeing mortgage stress rise to 22% in the UK, 33% in Canada, and 38% in New Zealand. So definitely a consistent trend that we're seeing across markets. I think also really important to note is not just rate rises that are driving this stress, that absolutely is a factor. In all of these markets, what we actually see as the number one driver of mortgage stress is the increase in cost of living, and consumers being worried about making ends meet, rising grocery prices, rising electricity prices, all of that contributing to the mortgage stress that we're starting to see. So what does that mean for lenders? It does mean that we're likely to see both increased rates of at least switching intent, as well as rate sensitivity or greater price sensitivity. So we're already seeing borrowers being more likely to say that they would switch if they saw another lower rate elsewhere. We're also seeing customers start to think about switching to a greater extent. So potentially an opportunity to acquire customers with quite sharp pricing, but also really a need for lenders to focus on retention strategies and really also focus on providing support to customers, providing empathetic information and answers to questions that customers have in the current environment. I've recently written a piece about this, so if you do want some more information, please have a read of that and feel free to reach out to us here at RFI if you do have any questions.